Hello and welcome. You're watching Financial Plan. I know the next half an hour we've been talking about a very interesting subject, and of course it talks about you and me of how difficult it is to invest in volatile times like today. To talk about that, we have with us Raghvendra Nath. He's Managing Director of Ladder Up Wealth Management. Thanks a ton, Raghvendra, for joining us today in the studios. Raghvendra, of course, you wake up, you read the paper, and from worrying about Greece not being part of the Eurozone to the dollar rupee going up to levels of 57 to the equity markets tanking about 3% in a week, it's extremely worrisome, and it's very volatile times that we're living in right now. In fact, somebody recently said that to me, that I'm lucky to see and to be born in a time like today, because not everybody's fortunate to see times like these. What does one do as an investor in such times?
Yeah, I think as you're rightly saying, these times are very volatile. Equity market, if you look at for the last 4 or 5 years, has been extremely volatile and has been doing more like a yo-yo movement from the peak of 2007. You are still, not retested that peak in the last 5 years. And moreover, I think this, in terms of if you look at the fundamentals in the market, nothing suggests that this market is probably going into another secular bull trend anytime soon. And if you look at even other asset classes, like for example, real estate, which is has had a 11-year cycle, up move. Gold and silver are historic highs, and even fixed income, there's been pretty high volatility over the last 6 to 10 months. So yes, these times are very volatile and challenging, and investors need to be very careful about where they are investing their monies.
Raghvendra, what happens to the psyche of an investor? Because at every point of time you think that the markets have fallen 500 points. It might just be a good time to go out there and invest. The minute I think you believe that, something goes wrong somewhere, domestically, internationally, globally. And a lot of people who have invested in the equity markets, at least in the last couple of years, are still down to negative returns. Yeah. When you're already sitting on such huge losses, how does one gather the courage to go out there and buy any given asset class?
Yeah, so equity, as the pundits say, equities always make money in the long term. And when you're talking long term, typically you're talking about a full cycle of investments, so there are boom cycles and bear cycles, and so you need to experience a full cycle of investment. And therefore, investing for probably 7-8 years kind of time horizon is when investors will start seeing real rates of returns. So yes, you're right, last 2 years, if somebody has invested 2 years back or is still sitting on losses. But one needs to keep in mind that periods of extreme pessimisms are the best periods to invest money into the stock market. And every period of pessimism is followed by periods of exuberance. So waiting, having patience, investing in right quality stocks, diversifying their investments well, and then waiting out is the best thing to do, and that's where you can actually make sizable amounts of money.
How does one determine that? Because of course it seems more like trying to catch a falling knife. There are people who ask questions like, how do I have faith in a company stock that I'm buying? I mean, you had a Mahindra Satyam, you had Satyam that went under. Nobody expected that. You have banks worldwide that are collapsing right now. How do you convince a retail investor who's not even got the knowledge or the know-how or what's really happening across the world to go out there and buy into any asset class or even begin their financial planning? Because I think the normal nature of humans is that, if you can buy it right now, why buy it if it could be 10% cheaper in a couple of weeks, right?
That's right. So one is trying to catch the bottom is never a good thing, and you never know when the bottom you'll be able to catch. And second thing is buying into the right things. And especially in these kind of volatile times, people need to choose their investments very carefully. So like you mentioned about Mahindra Satyams, probably in the stock market there are so many less worthy companies which are lurking, and where there's price manipulation and all that, and investors get hurt. And therefore, if you are not extremely confident about the subject, then probably give it to a subject matter expert. And that's where probably for a retail investor, mutual fund comes into being. For a high net worth individual, probably a portfolio management scheme comes into being, where these experts who are working day in, day out and actually identifying and researching and figuring out which are the best stocks to buy, they create a portfolio for you. Right, so that becomes a much safer way of investing.
Right, that of course is for equities. I mean, it's been similar for real estate as
That's
well.
right.
You know, I mean, we saw the land boom and everybody was talking about real estate and we're pretty much going down the road of the buy. I'm hoping that the bubble doesn't burst the way it bursted for the Middle East. But again, that's another space that a lot of people have gone and locked their hard-earned money into, you know, asset classes that are high risk in nature, but high risk is high return. You're not seeing any of those returns today.
So equity, as far as real estate is concerned, yes, the story is a little more difficult because one, you need large sums of money to actually partake into any good real estate opportunity, unlike equity where you can invest with small amounts of money. There is no concept of systematic investing in real estate. And therefore, you know, you need to be extra careful about what kind of property or what kind of land are you getting into. And especially now for somebody who's looking at real estate investments, we have already seen a 10 to 11 year up move in real estate. And real estate cycles traditionally across the world have lasted 10 to 12 years. So you are actually getting into a situation where the future returns on real estate probably will be much more reasonable than what people have seen in the last 4 or 5 years. And therefore people have to tone down their expectations. And second is that the size of the investment now has gone to such a large extent that investing probably may not be the most worthy idea at this point in time in real estate. So if you are looking at buying for your own use, let's say a shop or an office or a house, still, you know, people should look at options. But if they are looking at investing, maybe investing into areas where the real estate boom has not caught up so much, rather than investing into probably large cities, could be a better choice.
Right, Raghvendra, also normally safe haven, gold and silver. In the recent couple of weeks, gold has fallen off quite sharply, a lot of it coming on back of actual demand easing off it, you know what India has done as well in that case. Not too many people are as optimistic about gold and silver anymore. Do you still think these are good spaces to be in? Because safe haven suddenly has become the US dollar and the gold as its reputation is actually losing its sheen. What happens to gold and silver?
See, retail, for a man on the street, a retail investor, gold has always acted as a store of value, okay, and to be used in difficult times or in most difficult times. And that store of value concept related to precious metals, whether it's gold or silver, still stays true. Okay, so if you just overlook the day-to-day price movement of gold and look at it as a store of value which could be of use on a bad day or on a rainy day, and then you are looking at investing into gold and silver for very long periods of time, probably even these times are good to invest. Because historically, if you look at, and we did a study for almost last 88 years of gold prices, gold has never seen a big reaction like stock markets. You know, so gold falls off, but then remains stable and probably starts gradually recovering. You know.
Of course, we've talked about how it might not be such a bad idea to look at a number of asset classes right now. What about fixed income with an interest rate scenario which seems to be easing? I mean, a lot of people are betting on a more aggressive rate cut coming in from the RBI for obvious reasons. How is fixed income expected to play out? Would that be a space that one could hide under?
Yes, very much. In fact, fixed income, I think, is in a sweet spot. If you look at all the asset classes, be it gold, equity, real estate, and fixed income, if somebody has a medium-term horizon, let's say 3 to 5 years, fixed income investments today are the best bet for an investor because of the high interest rates. Most banks, most PSUs, corporates are offering very, very attractive rates of returns. And it makes eminent sense for any retail investor to lock on to these investments for as long a period as possible, because as you rightly say, you are sitting at a juncture where the only movement of interest rates seems to be downwards or southwards, you know, and therefore locking interest rates at these levels and for a long period of time will actually help investors.
Right, Raghvendra, so if I had to ask you, what is the advice that you have for a retail investor right now? How should one beat volatility and, of course, make the best use of these very pessimistic times that we are seeing?
See, in times of such volatility, I think investors need to have patience, and they need to tone down their return expectations, because if your return expectations are high, probably you will end up taking risks which are not suitable to your profile, and in these volatile times those risks can work against you. And therefore investing with reasonable return expectations in mind is very, very important. And investing in trustworthy places, places where you can trust, people who you can trust, taking the right advice from right kind of people, and choosing the products which are actually safe. So if you look at fixed income, there are so many options, but in fixed income probably people need to choose the best possible or the safest possible options. And the fourth thing which is most important in these kind of volatile times is diversifying, because across asset classes, because you don't know which asset class is going to play how, and therefore